So just to summarize what I've covered so far, the first tab here in the spreadsheet is just creating an itemized list of your startup costs for the startup of your business, or in the case that you already have a business and you're just taking on a new project, create an itemized list to start or undertake that project, break it down by item and by expected price or cost, and you can put your business name, you can choose if it's startup or project, and then the date. And then from there, you move to cash flow statement year one. Make sure this is up to date for your business in terms of the dates and in terms of the forms of cash inflows, because every business is going to be different. Make sure you're then reporting the money that's coming into the business each month by category and make adjustments as needed. Next, you're going to move down to cash outflows, so money going out, so expenditures. And again, just break it down by month, by category. So for example, rent deposit is one category of money that would be going out, and we have that rent deposit reported in May. So again, in this section, you want to make sure you're covering all your startup costs or project costs that are reported in the first tab to show that those startup costs or project costs are actually coming out of the business and to show when they're coming out. From there, you just continue to do the same thing for the second year and the third year, and things will change a little bit. As your business grows, you're probably going to have more revenue coming in. Maybe you will expand services, or maybe reduce your services. Maybe you'll have some new ongoing expenses that you didn't have before. Maybe you have some new subscriptions, or you hire an employee a year and a half in or 2 years in. So just make sure that you adjust the cash inflow section and the cash outflow section for your business and for things that are changing over that 3-year course. So now the last part of this video that I'm going to cover is just reviewing the bottom lines here. So as I mentioned at the top here, you have your total inflow and you have a subtotal there, which should capture all the numbers above here. So you can just make sure the calculations are correct in case you're altering the spreadsheet at all. And then down here, line 27, I have the subtotal of total outflows. And now what's going to happen here in line 29 is it's net cash flow. So net just being the difference. So that's the subtotal of inflow minus the subtotal of outflow, and we get the net. So you can see in this month, in March, we had $5,000 coming in and none going out. So we have $5,000 net positive cash inflow. Whereas in this example, in the month of April, we had $20,000 coming in through a business loan being administered to us, and we had $3,000 going out. So the difference between 20 in and 3 out is 17. So it just does that for each month. You can just make sure the calculations are correct. And then the bottom line here is the closing balance. So this closing balance is showing how much cash we have in the business at the end of the month. So you can see for the month of January, there's just nothing happening yet in this business when I highlight this column. So it's all going to be zeros there, and same thing in February. But for the month of March, there was $5,000 coming in and no money going out. So therefore that net cash flow of $5,000 translate to $5,000 as a closing balance in the business. And then the next month, it's a positive net 17. So $5,000 already in the bank account plus a new additional 17 coming in. It's added together there to be 22. And now in this month, you can see that there's a negative net cash flow. The owner has brought in some money, has received a business loan, and that's to cover these expenses. So it's very normal starting out to have some months where there's a negative net cash flow just because of those startup expenditures. So you can see in this month here, in the month of May, the negative cash flow was negative 10,450 because there was no money coming in for this month, and there's quite a few expenses to get the business going. So there was a net loss of 10,450, and now because of that, that reduces our bank account or closing balance by 10,450, which brings us down to 11,550. So there are reasons why the statement of cash flow is really important. One of them being just so that you can get a visual of all the money coming in and going out, and when it's coming in and from where it's coming, and when it's going out and where it's going to, but also so that you can see the net each month, because it's really important in business to have a net cash flow. And that might not happen every month, and that's okay, especially starting out. But once the business is up and running and you've paid off those startup costs, then you really want to strive for being cash flow positive each month, because if you're cash flow negative, then you're going to run out of money. And now another reason why it's important is because it shows your closing balance here. So you want to make sure this is always positive, because if your closing balance becomes negative, then you don't have any cash available. And if you don't have any cash available, it's going to be hard to make your loan payment. It's going to be hard to pay your rent. It's going to be hard to pay for supplies or employees or things like that. So when you're applying for a loan, it's really important to have a positive closing balance and to have a net cash flow in as many months as you can, because lenders are going to look at that, and the lenders want to make sure that you're going to be able to pay back the loan. So if you have net cash flow and you have a positive closing balance each month, then that's a really good indicator that you're going to be able to pay back the loan without any problems. Whereas if you're expecting to have negative cash flows and a very low closing balance or negative closing balance, then you're going to have cash flow problems, and it's going to be really difficult to meet those financial obligations. So this can be good as well to get your own visual and know when money's coming in and when it's going out. And also you can be strategic, where maybe you see that you're going to have some months where it's a net negative cash flow and maybe your closing balance is getting pretty low. Maybe you want to delay some expenditures to a later month when your closing balance is higher, just to be strategic so that you're not having to go into debt or run out of cash to, say, buy some more furniture or do some renovations that can wait. So hopefully that was a clear explanation. And now, just to wrap up this last video here, I'm going to click on the 5th tab here, which is the cash flow summary. And so this basically just summarizes what has happened in all 3 years. So you can see that in the past tabs, I have a breakdown for each month. These are just combining them per year. So in that example I gave you, I made it really simple, where there was just one revenue source. So you could go here and delete those 2 rows if you want. And you could add a new line here if you want, just to show separation between revenue and owner contributions or business loans. And so this tab, you don't really have to do anything in this tab so much as just make sure that the calculations are correct for the annual totals for whatever 3 years that you're going with. And then also with cash flows, you'll have to make some adjustments here just to make sure that column B actually has the accurate items that you've put. If you have 2 revenue sources or 3, if you have a grant in there, just adjust those. And then the same thing with cash outflows. I just have some generic ones here that a lot of businesses are going to have to deal with, but you can make this reflect your business and just make sure that they line up with the other rows on the other tabs. So this last tab is not so much a sheet that you have to input information in, it's just confirming that it summarizes those 3 combined totals. So once this is all completed, you've filled out each year, you've updated your revenue sources and forms of inflows, and you've updated your sources of outflows, given the appropriate values to them, then you're basically done filling out this template for the financial statements, for the cash flows, and for the startup and project costs.